I'm John Kaiser. Thank you for coming out on a Sunday afternoon. The title of my talk, Lithium Dawn or Twilight's Last Gleam, is a sort of play on the idea that if decarbonization of the global economy that doesn't happen and slows global warming, we probably are facing a kind of an end times mentality. And the main theme of my talk is going to be about how lithium has to happen in a much bigger way than so far is in the pipeline in order for electric vehicle adoption on a mass scale to become reality. Now, what's occupying everybody's mind right now is inflation, and you can see that after subdued inflation for several decades, we are now back to the level where it was in 1981-82, in a period where they had to crank interest rates to 17-18% to subdue inflation. And the interest rates hikes have only just begun, and the market is terrified. And the resource sector, in my view, is suffering unjustified fallout from the expectation that we're going into a severe recession, maybe even a depression of sorts. But the mistaken thing there is that the inflation isn't just too much money printing and need to cool stuff. Part of the inflation is due to supply constraints that have evolved over time, in part due to the bear market that developed for resources in the past decade, which discouraged the majors from putting new projects into the pipeline. So here I kind of track the two cycles from 1920 to 1937 or so, and I've paralleled it with the last decade's market, which is the blue. And we look like we're ready to fall off a cliff. And we're dealing with all kinds of stresses in the system, like a struggle between autocracy and democracy, sort of challenges that we saw in the 1930s. So something that worries people like me is, are we heading into a 30s type scenario where you have fascism take over and totally rearrange the way we think about everything? And in the background is this reality of the Chinese economy eventually converging with the American economy in terms of size. And that convergence used to be projected for 2030, but now it's for 2027. And this is the big picture conflict in the background, and it will probably result in the fragmentation of the globalized economy into separate zones. And that's also very important for the resource sector, because here is what the China-Russia axis supplies in terms of all the key commodities. So if you have this autocracy axis, China, Russia, and whoever they attract as an ally, we in the West are going to have some serious supply problems. And this is a picture of resource sector. The blue is the traded value of venture listings. The green is the everything else. And the red and the yellow lines are the relative percentage of traded value represented by the non-resource companies in the red and the resource companies in the yellow. And as you can see, we've been in a bear market, a 10-year bear market for resource juniors. And you can also see it in the subdued value traded. And we had a bit of a spike there in 2020 in response to gold going over 2,000, but we're already back in this fading thing. But this is very interesting that the resource stocks this year have dominated the trading value on the venture exchange. And part of this is the shift away from tech spec and cannabis and all these other things. People are realizing that game is over, and they're also recognizing that the resource sector, it's going to have its day in the sun, even though we may be in a flatlining equity market that loses another 25% or so and then just goes sideways for a while. It is actually possible for the resource sector to boom during that period. Now, this talk, I'm not really talking to the people here. I'm talking to a missing audience. I'm talking to the younger generations who may see this on the YouTube video in the following months. And I see what's happening with this lithium dawn that I'm talking about as a gateway to pull a missing several missing generations into the resource junior sector. And I'm a boomer. The youngest boomer will, by the end of this decade, be 65, retired. And there really is not a proper audience who understands this sector, who's willing to speculate in it. And gold is kind of a turnoff, because gold is an end-timer's favorite commodity. And young people really don't want to hear about gold. They want to hear about something that offers a positive future for them. So the story is that by 2035, 40, electric vehicles will replace internal combustion engine cars. And the interesting thing about that is, when you take this chart from Rio Tinto, you need about 10 times as much lithium supply as is in existence right now to make this a reality. And electrification of the car fleet is not going to stop global warming, but it will help slow it down. And the whole goal is to try and keep this global warming process as slow as possible. It doesn't mean turning off natural gas or stop burning oil, but to gear towards this transition and maybe hope that fusion energy becomes a physical reality by 2040, and which would change absolutely everything. Then all the renewables and all that sort of stuff become irrelevant, but lithium-ion cells will probably still be part of the electrified transportation fleet. So, is that really the next one? Yeah. Okay. So people, when you look at these sort of ESG NGO type channels, they'll talk about, yeah, mining's dirty, it's terrible, you should just recycle. This graphic shows that cumulatively, all the lithium that's ever been produced, most of it went into glassware and ceramics. More recently, it's gone into cell phone batteries and laptop batteries. And it's only in the last 5 years that we've seen the electric vehicle demand emerge on the scene. And I admit, like 3 or 4 years ago, when we first had the Lithium Mania happen, I was a skeptic about the timing as to whether and if this would ever happen. But here's the thing about recycling. It's a real solution, but it's not a reality until 2035, 40. And that assumes that we get up to 1 million tons of lithium metal into production by then. So when people say, don't mine lithium, just recycle it, tell them they need to learn to do the basic arithmetic, because there isn't anywhere near enough lithium in existence to recycle, and just use that to make lithium-ion batteries. So this is the lithium carbonate price, and it's been a dog for decades. It took off in sort of 2015-16. That's when the Tesla started rolling off out of the factory, and people started seeing the potential. The first Lithium Mania, I call it 0.5, sort of took place in 2008 to 2012, and that's where we had a few lithium companies like Canada Lithium, which put the old Quebec Lithium project, tried to put it back into production, and that failed in bankruptcy. And then things kind of got quiet, but in 2015, the second wave, 1.0, came into existence, and Nemaska was part of that, and it also ended up in bankruptcy. And so for Canadian lithium plays, we have this sort of stigma, yeah, lithium in Canada it's a failure, it's not going to be part of the equation. Except the message I want everybody to take home is that the future of lithium supply actually resides in Eastern Canada. And that's what I'm calling the Lithium Mania 2.0, awareness of which is just getting underway now. Now, the reason we had this fall off in the lithium carbonate price is that with the Lithium Mania 1.0, the Australians, they really did what juniors do. They got all those pegmatites, they properly delineated them, and they put them into production. You can see this incredible spike of supply, but it was a little bit too early. The EV adoption wasn't happening that fast. And so then the price crashed from $10 a pound down to $3 a pound, and basically nothing, no pegmatites work at $3 a pound. If that's the future price for lithium carbonate, there will be no electric vehicles that use a lithium-ion battery. So the interesting, stunning thing that happened was during the Trump administration, he did his absolutely best to, throw cold water on the global warming idea of trying to mitigate it, calling it a hoax, reducing fuel efficiency standards. And yet, when the election was done in November 2020, we were shocked that the electric car sector, the car makers, paid no attention to him. They had accelerated their production and tooling up of electric vehicles and their lithium gigafactory supply. And that's what caused this big boom last year, that suddenly these lithium stocks all woke up. It was the realization that one politician isn't going to stop this transformation that's happening. And the interesting thing is, look at this. This doesn't even include China. Look at all these gigafactories that they're building. These things make lithium-ion batteries. And all the spodumene processing is done in China. So these guys, and China, of course, has is the biggest EV maker right now. These guys forgot about the raw material lithium. They have not thought all the way upstream. And this waking up is just happening now. And that's why I think this big boom that's coming, it's going to revive the resource juniors and bring a younger audience into this space, teach them how it works, and then keep the ecosystem alive for another generation when they map the knowledge gained from how to think about resource plays to other metals, which the West is going to be in critical shortage if this Russia-China axis doesn't dissolve and we go back to a globalized economy. So Rio Tinto had this fantastic slide in September presentation last year. And what they're saying is that they found that Jadar deposit in Serbia. It's a different style of mineral. So far it's unique in the world. It's got world-class scale. It's hung up now in politics and corruption. But they've said in order for this growth to happen, we need 60 such deposits. And that's an incredible statement. It's one thing for a little junior to blather on about how much more we need. It's another when there's a major mining company making statements like that, because they've done the research, the homework to support a statement like that. So where does it come from? About 55% of lithium comes from pegmatite deposits, and the bulk of that is from Australia. 45% comes from brines that are in Argentina, and Chile, and China has some brine and some pegmatite. So the question is, where is the rest going to come from? One of the things to understand is pegmatites have no relationship whatsoever to brine deposits. Pegmatites are formed through fractionation of melts in certain sort of continental zones where there's a collision going on that spawns new igneous intrusions that swallow up the existing rock and harvest the lithium and other critical elements from it, and then end up migrating far away, usually up some structural crack, and then depositing themselves as dikes or lenticular bodies. Whereas the brines are formed through closed basins that water circulates through eroded material, and slowly over time concentrates the lithium, which then water sort of dissolves, and then they pump this out and evaporate it and get the lithium that way. And sort of a subset of this is these claystone deposits, which are very low grade, difficult to process, and require a significantly higher lithium carbonate price than the pegmatite bodies do. Now, another interesting thing is that most of the lithium supply right now comes from water-challenged parts of the world. The lithium triangle, the reason it has these salars there is because it's one of the driest parts of the world. And the pegmatites in Western Australia has nothing to do with the temperature of the place, but Western Australia is a very dry place. Global warming is going to continue, and these temperature problems are going to get worse, and water supply problems are going to get worse. So just counting on the brines from places like South America to take care of the lithium supply It's not going to happen. But check out Mosquito Land, eastern Canada, the land of bush and swamp and lakes and that. There's no water problem there. And yet this region has a bounty of pegmatites that were found decades ago by academics. They studied it, but there was no market for it because it was all controlled, supplied by a couple of world-class deposits like Greenbushes and Tanco. They just took care of all the other needs. But it is this immersion of an entirely new category of usage, which is sort of unprecedented for these metals. It's kind of like with rare earths when they invented the permanent magnets. All of a sudden, neodymium and dysprosium became super important, and the demand for it went through the roof relative to what it was before, when it was mainly for the europium, which made the phosphors in the color televisions. So an Australian group had a little article out recently that lamented that the Australian lithium stocks, and there's about 140 of them, have been hammered in the market recently as part of this general sell-off. And people are saying, okay, yeah, the lithium boom's over, it's done with, and they sort of argued, well, no, actually the need for lithium, more lithium, it's still there, and unless you expect the electrification of the car industry to not happen, this has to happen. And they were sort of arguing, we're in here, this trough of disillusionment, where it's going to become like that. But the reality is, because of the magnitude of more required, we're actually going to go through this again. And the Canadians, some stocks have started to respond to it, but most of them have not. Now, why do I think this is an ideal gateway for young people to discover the resource juniors? Well, one, they've been into momentum gambling, but that's over. We're not going to have the kind of trend is my friend markets for some time, maybe in specific stocks or very precise sectors, but not in general. So resource juniors are not good for momentum gambling. They are based on a slower fundamental outcome gambling that unfolds over months, years, and is punctuated by events of news that to which the market adjusts. It's a different style of gambling. It requires you to understand the size of the prize, what the reward will be if things work out. Now, the young people don't care about gold. They don't really care about that we need more nickel for stainless steel or copper for wires or stuff like that. But they do care about the future for themselves, so that when they have their children and grandchildren, that this is still a habitable planet. So they can identify with lithium. Making more lithium become into existence, this matters for them, so they can care. Just like they liked the cannabis stocks because they all smoked the stuff and knew what it was all about, they can identify with lithium. They cannot identify with gold because gold is kind of like a capitulation metal. They don't want to hear about gold. Yet all of us, we've been in this space with gold stocks for whatever, last 30, 40 years. Now, they also realize that, or are beginning to understand that without lithium supply, this electrification will not happen. It just won't happen. Tesla will end up at $1 a share because right now it's a vanity stock or car. People who are wealthy enough can afford it, but there needs to be a lot more lithium at a reasonable price for there to be for it to be affordable and have the masses adopt an electric vehicle. Now, the interesting thing about these pegmatite bodies is they're relatively simple compared to squirrely orogenic gold deposits. They're either in dike form or in sort of lenticular bodies, and once you find them, you drill them off, you find out the tonnage, you figure out the grade, and usually it's spodumene. They understand the cracking process. It is expensive, but it is not like rare earths with complex mineralogies getting in the way. And interestingly, there may be more Greenbushes and Tankos found in Canada, but you can't count on it. So this is a game that's not for the majors. These things are too small. The majors will buy out the bigger and better ones, that hundreds of juniors going out there and scraping the moss off these pegmatite trends and measuring these bodies that were documented decades ago just in passing exploration by various explorationists and academic scientists. And also, for almost any startup concept, what are the disclosure requirements? Well, for resource plays, they're huge. 43101 in Canada and JORC in the US, the disclosure requirements are very intense. So the data that these companies generate is actually something you can get your head around and start to think intelligently about what's happening and not just guessing whether or not this whiz-bang technology is going to become the next big thing. And there's also tools for valuing, like my rational speculation model and visualizing outcomes, quantifying the size of the prize. It requires work, but it can be done. Online technology is emerging, which will do a lot of it for you. So there is a way to bet quantitatively, not just qualitatively, in these resource juniors. The other thing is, like the venture capitalists in Silicon Valley, they bet on dozens of startups and count on a couple of them to become absolute successes, several of them to become absolute duds, and the others in some way, half succeed. But the only access is through private equity funds, and young people really don't have access to that. Resource juniors, they're all startups. I call them bottom fish. They're all cheaply priced. You have to play them as a statistics game. Don't pick your favorite and run with that. Get a collection of them, and then play the whole system. So for this younger generation wanting to get in this game, they will have lots to choose from, and they can try and make the best portfolio possible out of this. And of course, eventually, when they learn this game, they'll wander into other categories, other metals, and they'll be around for a long time to sustain this sector. And this is just sort of a splash page showing, here's the exploration cycle. These are all stages with different levels of uncertainty. And there's the basic formula for how you value something. And here's sort of a way of graphically presenting how this all works. I do this in my service, and this is why my subscribers use it to sort of help themselves figure out which ones are the good bets, which ones are the poor bets, without even bothering to ask me. So here's an example of what you're going to start to see. Frontier Lithium had the Pax deposit discovered in 1999. The predecessor company was a dog for 20 years, a flatlining bottom fish. And then in 2018, they stepped out and found another one, Sparks, and put together now two resources. And they just completed a PFS, which had $9.45 a pound lithium carbonate. It's now $32 a pound. It had an after-tax net present value of $1.3 billion or $5.65 a share. And so this stock suddenly woke up and shot from 50 cents to as high as $4. Right now it's succumbing to the general market sell-off. But this sort of thing you're going to see a lot more frequently. Here's a more recent example. Several years ago, I had the predecessor company at the Metals Investor Forum when Midland's Mithril copper discovery looked like it was going to be something interesting for Quebec. They had this Corvette lithium thing, but the lithium prices by then had tanked, so nobody cared. This has been revived. They raised money. They're now drilling it off. They're getting thick intervals between 1% and 2%. They've got a whole trend. And this stock has shot in like the last 6-7 months to as high as $450. So this kind of rapid price appreciation from a doggy junior is going to be part of what this game is about. And that's, again, what's going to be of interest to the younger generations, this idea that they can make a 10 to 100 bagger from a company where they can actually understand why this is possible. This is something that's not really possible in the spec tech market. And the two companies that I have here today, Brunswick Exploration represents the very early grassroots stage, and Avalon is like a Frontier Lithium. It found a big whopper deposit at Separation Rapids in 1997, but has always been seen as just a future supply for the glassware ceramics industry, but it is now part of this whole game. And the key thing for the lithium is that the battery makers need lithium hydroxide. And that means Canada needs to build these refineries. And Avalon is now pairing up with an Indian company conglomerate called SR to build a refinery in Thunder Bay, which will take feed from Separation Rapids when it's developed, and possibly from others in the area. So you're going to start seeing, and the Ontario government, believe it or not, is actually in support of this happening, because they understand that these critical metals are necessary to make the electrification of the car sector a reality. And so there you can see the valuation difference. Like, here's the ones that have already taken off, have these very high valuations. And these ones, Avalon's being priced as if it's not in the game. And Brunswick, which has assembled, seven or eight trends in eastern Canada of pegmatites that were found ages ago that haven't even been staked, and are going to use a systematic process of eliminating the ones that are duds and homing in on the future discoveries. This is like at the very beginning here, and both these companies have billion-dollar outcome potential. And here's how I've done it. This is another thing. This is the discounted flat cash flow model. Avalon did a PEA in 2015, and the cost numbers are probably a little bit stale. I've updated this to show what happens to the NVV, even based with 415 million shares fully diluted. Look at $10, which was their base case price back then. This is the sort of range that you can see here at this price range where it is now. You're talking about a 12-center going to like $19. Now, lithium carbonate at $30 plus is not the future. And this is the peculiar thing. In the resource sector, whenever a metal goes down, everybody cries in their beer and complains and sells off. With lithium carbonate, it needs to come down. It will be cartwheel time if it comes back into the $10 to $20 range, because otherwise the car makers are going to say, screw it, we're not going to bother with this. So it has to come down to a reasonable level where it works to make those future affordable lithium cars when they're ready for mass consumer adoption. And here's an example why $30, $40 lithium is not going to hold, because in 2035, when there's 1 million tons in existence at that price, it's $400 billion worth of lithium produced per year. That's the value of all the aluminum produced right now. So you think about it, that's not going to happen. The sweet spot is down here in the $10 to $20 range, and that's where the value is reasonable. So gold is a $100 billion a year market. It is plausible to see lithium becoming a $100 billion a year metal. That's serious scale. And of course, I have a gold company here too. So this isn't all about optimism of the future. It's also possible that people will see that this is not going to happen. The temperature is going to keep rising. Climate change is going to destabilize things. We could get even an autocracy in the United States. Everybody could end up in sort of a depression type mode. So if you're going to put together, as a young person, put together this portfolio of lithium bottom fish, put 1 or 2 gold stocks into it as your hedge. And you don't need to see the lithium thing fail for gold to flourish, because there is still this struggle between China and the United States to think about, which will carve up the global economy into 2 zones, and the US dollar will no longer be the single reserve currency. And here's sort of like the vulnerability. This is what America produces of the various metals in the world, like next to nothing, and yet it's the biggest economy in the world. So there are stresses that are brewing that are not going to go away, and gold is going to see a real price increase, not just tracking inflation, but a real price increase, which will make projects like Sonoro's Cerro Caliche suddenly very interesting. And there again, what I've done is I've taken their scenario and extrapolated the 6 years or so they have already outlined to 14 years, because they have the mineralized footprint where you can see the potential, but it takes money to prove it's there. So this company, unlike others who just drill it off and do a pretend PEA and then wait for gold to go up and some other company buy them out, they actually are building the mine. They're getting it permitted so that when gold starts to take off over the next few years, they suddenly have a producing mine, and once you have the cash flow from that, then you can leverage it and build yourself into a significantly bigger company. And that wraps up my presentation. I do a lot of free stuff on my website. Kaiser Watch is a weekly audio program that I put out. And follow me on Twitter. I notify people of something new and unrestricted. And as for favorites, they're now free. I gave up trying to sell my best picks. What I do sell, for which people pay $4.50, is my bottom fish collection, curated out of the 3,000 companies, which I sort of highlight. These are the companies that are missing a piece. These are ones where, when that piece starts to fall into place, they'll give an instant 2-3 times price increase, and then I'll introduce it to the general public as a favor, and hopefully the free market out there takes it up another 2 or 3 times, or to whatever level you can see that the story is going to. Thank you.